Welcome back. Playing the property market feels like a safer game for some than dabbling in the stock market, particularly nowadays. But there's plenty to be mindful of to make a start and also to make smart investments and really build wealth through bricks and mortar. My next guest reckons you can lay the foundations for a retirement plan based around property. So let's hear all about it from the Managing Director of Creation Wealth, no, it's called Certain Wealth Group, isn't it?
Yes.
My producer got that one wrong. Bill Meehan, thanks for being on the program,
Thank you, Peter. Pleased to be here.
Look, Bill, tell us about Certain Group.
Okay.
Certain Wealth.
Certain Wealth is essentially a company which we created as a result of a need in the marketplace. I feel that there are so many different people selling so much out there. At the end of the day, how can you you go to a workshop, you go to a seminar, you come out of it, you feel good, but you can't go onwards from it. We're looking at creating a land-based portfolio of residential investment property, and to do so slowly, and to do so through equity and through duplication. That's what we're about.
Okay, so try to paint a picture of a typical client and how you can see that they would actually accumulate the property such that when they do retire, the money's going to be there for a nice, comfortable retirement.
Okay, so typically someone will come into us and you check out what their financial position is today, and most of us, as you know, are not in a good state. From the point of view of our superannuation, perhaps we thought we were putting away more than we are putting away. We will do a review with them. We'll find out, first of all, do they have any goals? And many of us, unfortunately, don't have goals. So we'll help them to structure some goals. We'll find out, in fact, where they are today, because many people think they're a lot better off than they are. You'll often get a couple to come in together, and they will believe they're doing well. We'll review it, and we'll find, in fact, that they're not going to retire. I mean, 90% of us retire at or below the poverty line today, which is pretty dramatic.
So it seems to me you're taking a financial planner's approach by starting off with what are your goals, where are you now, are you on track to make it happen? So, and you're going to find a lot of your customers aren't going to be on track to make it happen.
Sure.
What's the next step? How do you, in fact, you've got a chart here about our retirement position, haven't we? We should have a look at that one. Guys, can we bring it up? Okay, so, and this first chart talks about the retirement position of average Australians. Here we go. How Australians retire. I was quite fascinated by what's it telling us, Bill?
It's pretty dramatic. I hate putting this chart up. It's the only bad one in our workshops. But what it's showing us is that about 90% of us are retiring at or below the poverty line. Poverty line is regarded around $23,000, $24,000. And 1% of us are retiring around $50,000. And this is something we make clear to people.
Okay. So what kind of lump sum do you tell people they should be shooting for? And of course, it's nice to tell a young person they've got time to do it, but what are you saying that people should have as a lump sum when they retire?
Okay. From my perspective, it depends on where they are today and how long they've got to go. Everybody's like a fingerprint in many ways. We're all different equity position, different financial position, different age, different requirements. So from my point of view, if a couple can create, say, 6 or even more properties over a 10-year period, hold them for a couple of years, and then sell off a couple of them to reduce the debt, and then live on about $85,000 of positive income, almost CPI adjusted, remember, because you're increasing the rents every year. So it's not like if I put it into a fund and I'm drawing the interest on it. This is not going downwards. So about $85,000 after 10 or 12 years.
So your plan could see someone while they're still working holding 6 properties.
Yes.
And how many of those are going to be negatively geared and how many will be positively geared?
Again, it depends on the individual, and so we have to look at each case. But let's say the first one.
If you've got a big tax bill, you can have more negatively geared properties, obviously.
Well, you can, but it's not about saving tax. It's about many other things in there. If they come in, the first property, say around about $365,000 is what they're investing in. And with the present interest rates as they are, if they're on $65,000, it would be difficult for them to be negatively geared. In other words, it would be cost neutral or a little better. After 2 or 3 years, they've had growth. They've had particularly strong growth in rental during that time. The property is probably not only not costing them anything, but it's in a very positive position. So it's time to invest in another one. Take the capital growth that they've got from the first one, use it to acquire the second one. So use the first property to offset to buy the second property.
So essentially you're going to a financial institution and say, well, I bought this place for $365. It's now valued at $400. I've got this equity in this house now. Can I borrow again and do the same sort of thing?
That's essentially what it is, yeah. It's probably going to be worth more than $400, but, you know, because you can usually only draw about 80% of the equity in it, and then to acquire the second property.
Okay, now we've got a chart here of house price movements in various cities. So what is this telling us, Bill?
Look, the fascinating thing is there, if, you know, we'd bought in 1967, say in Sydney, as you can see from there, and let's say we'd put down $1,300 deposit, 10%. We'd borrowed 90% as an investment property. It would be worth something like about, well, more than 300 times. Not 30 times, but 300 times.
42,000.
Yeah, median house price.
And if you bought in Paddington, you would have been a lot higher than that.
Indeed, you would have been a lot higher than that, because this is just the median house prices across
a typical house for Sydney. And in the case of Melbourne, so Melbourne was actually higher. The median was higher in 1967.
At that time, Melbourne and Sydney usually sort of come and go, you know, similarly. Similarly, Sydney and Brisbane are linked. Every 5 years, one market overtakes the other market in terms of growth.
Bill, I know there's always arguments between, you know, people pushing shares and pushing property, but it would have been in your interest to work out what the sensible increase in house prices are, say for example in the metropolitan centres. What are we talking about per annum? Is it over a 10-year period maybe?
Peter, it's going to change from different capital to capital. We only work in capital cities and the suburbs around them, and that's mainly Sydney, Melbourne, Brisbane or southeastern Queensland, and Perth. At the moment, Melbourne is in a growth period, and we see them run through. We see Sydney move first, followed by Melbourne, followed by southeast Queensland, followed by Perth. And let's say Melbourne, which is the affordable market at the moment. If you're buying into the growth corridors, you're buying into a property that's going to be growing somewhere between 9 and 13% at the moment. So if you can get that for 2 or 3 years, even ASIC allows us to use 8.4% when we're calculating growth. The ABS stats are showing about 9.2%. I use 8%, you know, for my calculations, and still somebody can acquire 6 to 8 properties in 10 years based on that.
I'm sure people want you to be completely honest. What can go wrong? Because you must have clients who probably didn't follow what you wanted them to do, or maybe interest rates went through. What kind of problems can you have?
What can go wrong? We've got what we call cardinal rules. There are 6 rules, you know, and they are basically what land should I be buying, when should I buy it, where should I buy it, how should I finance it, is the demand there for my property, and can I afford it, can the tenant afford it, and am I optimizing my tax? I challenge people, if you get all of those things right, then it's very, very difficult not to be getting a good growth market. What can go wrong? Divorce, death. Certainly
losing a job.
Always is it. Losing a job, but I say to you, are you better with growth assets, having lost a job, or without assets? Many times you can get by, you know, you can get a job in a short period of time. If you hold off investing because you're worrying about losing your job, then you'll never be an investor.
I would figure one of the potential problems would be that people get ahead of themselves and try and do it too quickly to bring the golden goal along a lot quicker. Has that been an issue you have to keep your eye on?
It's an issue that it's always in front of us, because you get an older couple, say, you know, maybe 10 years out from retirement, who want to give you everything. Suddenly they realise you know, they're in trouble, and all of their life savings, all of the equity they've got in the house, they're prepared to risk with you. I will not allow someone to go ahead in our program unless A, they're comfortable, they're confident, and in fact they can financially do it. You should never be uncomfortable in a property investment, because it's a long-term thing and it's going to be with you for a long time. So even moving to the next property, you shouldn't do it until you're financially comfortable.
Okay, I wasn't sure whether you were implying this, but when your clients retire, do they effectively keep the properties and get their stream of income off the properties that they hold?
Interestingly, more, Peter, do. than certainly selling. Very, very few sell out.
And then roll into a super. Most actually keep the property.
Well, because when you think, let's say they sell 3 of them, which then means that they can reduce their debt because they're borrowing interest only. They're then getting a good, reliable income. Let's say $85,000, $90,000 per year income. Because rents are increasing all the time, that is, in fact, basically CPI adjusted, maybe 6 or 8 months behind the CPI adjustment, but there you have a regular income and it's CPI adjusted.
And I guess given the fact that we have a gross undersupply of property in this country, it helps your model as well, doesn't it?
It certainly does at the moment. In Melbourne at the present time there's about 46,000 shortage in domiciles and the demand over supply is at least 8,000 a year as well. So we're seeing in fact an increasing demand right across the country, but in particular in Melbourne at the moment.
Okay. I guess one last question. When it comes to borrowing, are you an interest-only fixed man? Or I guess that's a good question now.
Look, maybe yesterday. No, I generally prefer standard variable rate, depending on the person again, though. But I myself personally prefer standard variable rate with a discount.
Okay, now we've got a viewer question. I might get you involved in this one. And this one comes from Maria. And she owes about $130,000 on a loan for an investment property and wants to start paying interest-only repayments for a few years as she's recently taken a pay cut. Is this a good idea?
Again, it's hard, Peter, without knowing her financial position. It would be wrong of me to give you a direct answer. I'd be more than happy if she wants to give me a call and I'll talk to her about that. Generally speaking, if she's on a lower income or a less certain income, a fixed interest, even as it is at the moment, is still not a bad proposition if you can get 4 or 5 years on a fixed interest. But myself, excuse me, for all my investments, it's been based on standard variable rates.
Okay, but her question then was, should she be worried about going to an interest-only loan because you've got an investment property with principal and interest? What's your general view about investment properties and interest-only loans?
The market, generally speaking, it's better not to have them because you've got market forces at work, you've got inflation at work that's going to affect interest rates. Even during the Whitlam period, when we had interest rates of 18 and 22%, we also had rents increasing at a rapid rate, and we had house prices increasing at a rapid rate. They tend to link themselves fairly well together. It's only when you have a lot of other financial commitments that it becomes an issue then.
But of course, a lot of people, old-fashioned people, think that if you go for an interest-only loan as opposed to paying on the principal, there's something wrong with that. Because I think for a person who owns and lives in their own house, interest-only can be probably not a sensible strategy for some people.
I'm probably a perfect example. My dad grew up during the Depression. He was also Commonwealth Surveyor General, Mr. Land. So he really did know what he was talking about. But he said, son, you don't take debt. But he was talking about bad debt. He didn't know the difference between good debt and bad debt, or as it was then. So it took me 35 years before I could actually get over that problem.
And good debt is also when it can be tax deductible as well.
Tax deduction helps a lot, doesn't it?
It sure does. Mate, thanks for joining us on Switzer.
Most welcome, Peter.